This video I have to explain consignment. Meaning, consignment simply refers to the goods sent for sales. The person sending the goods is called the consignor. The person to whom the goods are sent is called the consignee. Consignment means a quantity of goods delivered to someone or delivering something. In accounting term, consignment means the transaction of sending the goods by one person to another who is to sell on behalf of the first person. And the person who sent the goods is known as consignor. The person whom the goods are sent is known as consignee. The next, differences between consignment and sales. The first one, ownership. Consignment, ownership is not transferred to the consignee. It remains with the consignor. In consignment, the legal ownership of the goods not transferred to the consignee, it only for consignor. Sales, ownership passes to the buyer. In sales, ownership of the goods is transferred to the buyer, not a seller. The next one, relationship, consignment, principal and agent. The relationship between the consignor and the consignee is that of a principal and an agent. Sales, creditor and debtor. In sales, the relationship between the seller and the buyer is a creditor and a debtor. The third one, expenses incurred. In consignment, expenses made by consignor. The expenses incurred by the consignee to execute sales and the expenses incurred by the consignor to send the goods to the consignee. So, both are borne by the consignor. Sales, expenses made by buyer. In sales, any expenses incurred after the sale is not borne by the seller. And fourth one, parties involved. In consignment, parties involved consignor and consignee. Sales, the parties are seller and the buyer. The next one, risk. Consignment, the risk of the goods remains with the consignor. The risk of goods under consignment is always with the consignor, not a consignee. Sales, the risk of the goods is transferred to the buyer as the sale made. When the sale is made, the risk is transferred to the buyer. Then, return of goods. Consignment, the consignee may return the goods to the consignor if not sold. The consignee can return the unsold stock to the consignor because consignor is the owner of the consignment. Then sales, goods once sold are generally not returned. The buyer cannot return the goods to the seller. Then statement, account sale is required to be submitted to consignor by consignee. In consignment, for giving details about the goods sold and expenses incurred by him, consignee send the account sale to consignor. Sales, account sale is not required to be submitted to seller by buyer. The buyer need not submit any account sales to the seller. Last one, commission. In consignment, commission is the main consideration of consignment because consignee sells the goods for consignor. Sales, profit is the main consideration of sale because the seller makes the sale for the consideration of price. Next, consignment accounting entries. Journal entries for consignment. The first one, for goods sent on consignment. If any goods sent on consignment to consignee, the entries are in the consignor book, consignment account data to goods sent on consignment account. Then consignee book, there is no entry because the consignee is not the owner of the goods. He does not purchase the goods, so he does not include this in his book. The next, for expenses incurred by consignor. If any expenses on consignment made by the consignor, the entry consignment account data to cash or bank account. Consignee book, there is no entry because the expenses incurred by consignor. Then for advance received. When a bill is drawn by the consignor on consignee and when consignee accepts the bill, the entries are consignment account, cash or bills receivable account data to consignee account, the consignee book, consignor account data to cash or bills payable account. Then for expenses incurred by consignee, the amount of expenses incurred by the consignee, the entry consignor book, consignment account data to consignee account, consignee book, consignor account data to cash or bank account. Then for sales by consignee, cash sales of consignment, the entries consignor book, consignee account data to consignment account, consignee book, cash or bank account data to consignor account. Next, for commission due to consignee, the amount of commission payable to the consignee, the entry consignor book, consignment account data to consignee account, consignee book, consignor account data to commission account. Then for profit loss on consignment, the amount of profit earned transferred to profit loss account. So profit entry consignor book, consignment account data to profit and loss account, loss profit and loss account data to consignment account. The last for settlement from consignee, it is a final settlement consignor book, cash or bank account data to consignee account, consignee book, consignor account data to cash or bank account. Next, valuation of unsold goods. Many times the goods sent on consignment may not be sold out completely by the consignee. This good is treated by the consignor as stock of goods with the consignee. This stock of goods should be properly valued and accounted to get correct profit or loss on consignment. The consignment stock is valued either at cost price or market price, whichever is less. If all the goods are not sold by the consignee within the accounting period, so the unsold stock is brought into the consignor. So the unsold stock in the hands of the consignee should be valued on cost price or market price, whichever is less. Format for valuation of unsold stock: cost of goods sent, then add consignor expenses, freight, carriage, loading and unloading charges, insurance, export and import, dock duties. Then add consignee expenses, cartage, landing, unloading charges. The last we will find out total cost of valuation of unsold goods. The next, loss of stock. Goods sent on consignment may be lost, damaged or destroyed either in transit or after they reach the consignee. The goods are consigned from the one place to another. The goods may be lost, destroyed or damaged either in transit or in consignee stores. So, such loss can be divided into two parts: normal loss, abnormal loss. Normal loss: when the goods are lost due to normal characteristics of the goods, it is called normal loss. Example: evaporation, leakage, breakage, drying, etc. This loss is unavoidable. A normal loss means a loss which is inherent in nature, cannot be avoided. It usually arises due to natural causes such as evaporation, leakage, breakage, etc. So, the formula for normal loss: total value of goods plus non-recurring expenses divided by total units of goods sent minus normal loss in units into closing stock in units. Next, abnormal loss. Accidental loss or loss due to negligence is called abnormal loss. It is not natural and unexpected. Example: flood, fire, earthquake, war, etc. The value of such loss is calculated as like calculation of closing stock. Abnormal losses are losses that occur accidentally or due to the carelessness. A loss for flood, fire, earthquake, etc. Then entries for abnormal loss. For abnormal loss account data to consignment account, then claim from insurance company account data to abnormal loss account, then amount realized from damaged goods, cash account data to abnormal loss account.